Shares of LendingClub down more than 4% after beating on Q4 profits but missing revenue expectation. The company also announcing the acquisition of online-only Radius Bank, making it the first U.S. fintech firm to acquire a formal bank. Joining us exclusively is LendingClub CEO Scott Sanborn. Scott, good afternoon to you. Thanks for joining us.
Thanks for having me.
So, Scott, I want to start with the news of this acquisition. Is it fair to say this was your route to acquiring a bank charter yourself, or is it going to be contained separately, the acquisition target?
No, you're absolutely correct. We see this as a truly transformative acquisition for the company because what a bank charter does for LendingClub is allows us to take what is the leading digital loan provider online and combine it with a leading digital deposit gatherer, and it totally changes the earnings profile of this business.
Clearly, I mean, I can understand the rationale to do that. I wonder about the timing. Why now? And do you wish at all you'd move to have a formal bank charter any earlier, given that some of the big traditional banks now have much more developed online tech offerings?
Yeah, so the answer to the question why now is because now we're ready. With our Q4 earnings, which we just announced, we've crossed over into GAAP profitability, which is an important prerequisite for being able to obtain a bank charter. And with this acquisition, we now clear the path to being able to, like I said, offer that other side of the balance sheet and create a really category-defining experience for our members.
And the stock is selling off, Scott, after hours. Doesn't seem impressed with the deal, or maybe it's the lower growth expected in 2020. And we've talked about how, I mean, the market cap, I think it was over $8 billion when you went public, now just barely $1 billion. What is it that Wall Street doesn't understand or that has changed in terms of the expectation around this company?
Yeah, I mean, we're building something very new here. And it's been hard for the market to understand what lens to look through to see the value of LendingClub. But if you look at last year's results, we are the category leader in the fastest growing category of credit, and we took market share. We achieved new records with our customer satisfaction, and we achieved profitability. I think what this announcement does is it clarifies the lens through which we should be looked at. And through this lens, the market is going to see over the course of time that LendingClub actually is a top-performing company in its new set of peers.
When you say, Scott, that you can kind of cut out the middleman, as it were, when you argue that you can boost investor returns and lower borrowing costs, what is the factor that allows you to do that? Is it purely because you don't have the cost base of a bricks-and-mortar branch network, or are there other factors that you think allow you to differentiate yourself from the big banks as well?
Yeah, let me give that answer in two parts. So the first question is, I think, what does bringing a bank into the LendingClub's marketplace model do for us? And there, the path to value is really straightforward. One, we eliminate issuing bank fees from the system, right? That's part of the value chain that's currently leaking. It's about $25 million annually. Two, we're able to replace high-cost funding, warehouse lines, with low-cost funding, which is deposits. That's another $15 million or so a year. And three, we're able to balance sheet just a small portion of the loans we originate and start earning net interest income, which diversifies and grows our revenue. So those three things alone on a cash basis are about $80 million a year in income. So that's what the bank does. The question of what is LendingClub, how did we achieve market leadership in that core space? The answer is really by being, laser focused on the customer experience and using technology to keep it very, very simple for the user and very seamless. And by using this marketplace model, what we've been able to do is serve a very broad range of customers and get them the right product for them. Right? We're able to serve customers that banks traditionally serve and customers that specialty finance customers serve. So by being able to say yes to more across this broad credit spectrum, we're driving down the cost of acquisition and have created a much more efficient marketing machine for the company.